Welcome to Risk Matters, the insurance podcast brought to you by DWF and your global guide to the latest trends and issues in the insurance and reinsurance industry. Join us as we explore topical issues, emerging technologies, and the innovative strategies that are shaping the global future of insurance.
Good afternoon and welcome to Risk Matters, the DWF insurance podcast. Today we're going to be talking about geopolitical tensions and the impact on marine insurance. We've had quite a heavy year or so with escalations in violence in the Middle East and elsewhere. My name is Jonathan Moss. I'm a partner in the global risks team at DWF. So if we start at the Red Sea, that's become a hotspot in itself of geopolitical tension. The Houthi militants have been targeting commercial vessels with over 100 attacks reported since November 2023. The Houthis are a political and religious group which champions Yemen's Shia Muslim minority. They claim to be part of the axis with Hezbollah and Hamas, and indeed they have Iranian support and are declared to have Iranian support by President Biden. The Suez Canal has been impacted and affected. The Suez Canal accounts for around 30% of the world's container traffic, and what we've seen because of this disruption is a surge in rates, significant impact on global trade, and general supply chain chaos. In addition to that, of course, there have been other geopolitical tensions and problems. We have the Russia war with Ukraine, with its immense human suffering, but also its impact on global trade. There was an estimate that the trade figures, that's imports and exports in the world, would rise by 4.7% this year, but in fact they've decreased to about 3% as a result of the terrible war between Russia and Ukraine. In addition, we've had problems with the Suez Canal. So you'll remember that in March 2021, the canal suffered a blockage owing to a vessel that was wedged between each side. That was a 400-metre long vessel weighing 224,000 tonnes, the Ever Given. And again, that caused terrible impact and disarray in the region. And I suppose to guard against all those issues, we have marine insurance. And marine insurance is there to facilitate world trade and to protect world trade, and just to make sure that people still have access to goods, ships can still travel, and the supply chain is preserved. So I'm delighted today to be joined by two leading experts, Rob Hawes and Eric Noe, and I will pass over to Rob and to Eric to introduce themselves. Rob.
Thank you, Jonathan. It's a pleasure to be here. Thank you very much for the invitation and the opportunity to talk today. So my name is Rob Hawes. I work for Liberty Specialty Markets in Lloyd's and Company Markets in London. And I've been up there a couple of years, but I've been in the London marine insurance market now for over 30 years. So that's me. I'll pass over to Eric.
Yeah, thank you, Jonathan. Very honoured and a bit terrified to be here, to be honest. I mean, I've been in this business for the better part of 20 years now, and I don't think back in the days when I started, anyone would have told me that I was going to be on a podcast, God forbid. So delighted to be here. Thanks for the invitation. My name is Eric Noe. I work for Havrico as a cargo and marine insurance broker, and I've been in this business for a good 20 years.
Brilliant. Thank you. And once again, thank you for joining me today. So we talked about some of the disruption in the world, and we're going to look more closely at what that means for marine insurance, for London, for the continental insurance market, for Lloyd's, for the companies market. But perhaps we can also talk about wider problems that have been experienced recently. So there's been a marked rise in commodity prices as a result of all these issues and tensions. What else have we had recently? We've had a drought in the Panama Canal, which has had a huge impact on access to probably about 2,000 ports in, say, 17 countries. The MV Dali collided with the Baltimore Bridge. It was starting a 27-day journey from Baltimore to Sri Lanka when it struck the Francis Scott Key Bridge, with thousands of tons of steel falling into the Patapsco River. COVID, we haven't come very far from those rather miserable days of COVID, and rolling lockdowns in different places really impacted trade. So 10 of the largest container ports are in China, with Ningbo, Shenzhen and Guangzhou particularly impacted by rolling lockdowns. So really, when we talk about what we've seen over the past few years. I just want to look closely at how marine insurance has responded. Despite these accidents, despite these weather incidents and catastrophes, the market still appears to be robust, and charterers and owners and others are still looking at the market. But I'd be very interested to hear from both of you on your perspectives. Turning to Rob, first of all, please. Have you seen a rise in claims in the Middle East as a result of these incidents? How has it impacted your day-to-day work?
Thank you. Well, absolutely. We've seen an increase in claims. Of course, we have. I think just going back to your point, the marine insurance market has always been an enabler of world trade. And we see that now more than ever with the Houthi attacks, which, as you say, are taking place on a daily basis. We only obviously see the claims for the successful attacks, if you want to call them that. Hundreds of others, I'm sure, have occurred that we've never heard of. And, Iran supplying weaponized drones, and even now unmanned subs attacking vessels on a stealth basis with, tenuous links to Israel being alleged. Of course, that's providing us with a huge challenge in responding to that. But I think, the London insurance market has responded extremely well to that. And, we have a wider range of products, including the war risks and strikes rights and civil commotions coverage, which has, certainly grown in the last year or two, and which is in demand by ship owners, who are choosing to, for want of a better way of putting it, run the gauntlet of still going through the Suez. So we're enabling them to still trade and to know that they've got insurance coverage in place. The alternative, of course, is to divert your vessel, as a large number of container shipping lines have done, around the Cape, which takes 2 to 3 weeks longer and represents a huge increase in the cost of running your vessel, and the freight rates and the cost of everything is going to go up accordingly. So yes, we have seen an increase in claims. Obviously, you get some very large headline losses like the Dali, which we can perhaps talk about a little bit later on. But yes, we have seen an increase.
Thank you. And when it comes to the sensitivity and the vulnerability of the areas of the world where these claims are arising, does that mean that you have a problem investigating the claims, sending adjusters, looking at policy coverage? How have you responded there?
Well, policy coverage is obviously something that the insurer will be looking at. But investigating claims is always difficult when the vessels are at sea, and especially when a casualty is ongoing, of course. And we've seen some very difficult to manage casualties arising as a result of the Houthi attacks. One in particular, a crude oil carrier, which is incredibly difficult salvage operation, very difficult firefighting operation, and could still actually result in a major pollution incident, which obviously everyone wants to avoid, especially in sensitive fishing areas and the beautiful area that is the Red Sea and the Straits of Hormuz. So yes, we are having some more difficulty investigating those types of claims.
Thank you. And you talked about how vessels are now sailing around the Cape of Good Hope, and that it's taking, on average, I think 10 days to 2 weeks longer in transit. Do you consider that because of the longer voyage, there's been an increase in claims?
I haven't personally seen a major increase yet, but if you think about it, obviously the exposure to the action of the wind and the waves and the risks associated with sailing a vessel at sea are increased because of the length of time that it's taking. And of course, I touched on the increased cost of that to the owner, to the charterer, and that cost is going to be passed on to the shippers of the cargo and ultimately the end buyer, the consumer.
You, me, Eric?
Yeah, everyone.
We're all going to be suffering as a result.
Inevitably.
And Eric, in your role as a broker, how have the tensions, the escalations of violence and aggression impacted what you do day to day?
Well, it's interesting to see that we've witnessed a bit of a resurgence in terms of those war risks. I think the markets always provided war risk coverage, but it was slightly slowed under. I mean, if you look back a few years ago, there was cycles of fraud cases, there was cycles of misappropriation cases, there was a spate of piracy incidents, and all of a sudden there's war risks which which have come back to the forefront of events. And it was always there. The market is geared to it. There's capacity, there's clauses, there's wordings. But I think to have witnessed what we've seen first in Ukraine and more recently in the Red Sea has been a bit of a reminder, a healthy reminder, if not an eye-opener for the market. And so we're back into the old game of having to provide solutions for war risks. And I think those covers have also been quite extensively tested. I think Rob was alluding to the MV Sunion, which was attacked and then boarded and seized and then used for propaganda purposes, and she was a crude carrier, and the Houthis have basically blown up the hatch covers and made a big display of it. It underlines the nature of the risk. It shows that there's new weapons being used as well. It's no longer the floating mines or the traditional weapons of war. You've got drone attacks, you've got ballistic missiles, there's cruise missiles being fired at merchantmen. So it is actually quite intense and quite challenging and fairly novel in that sense. But as a marine peril, it's always been part of the job of us brokers and claims handlers to deal with. So in that sense, we're not being kept bored or idle.
I think if I can just add, the real tragic thing, of course, is that, we're now seeing loss of life associated with the Houthi attacks. Vessel the True Confidence, and very unfortunately 3 crew members lost their lives as a result of that attack. So we're not just talking about physical loss or damage to ships and cargo. These are these
real life, real world events
running the gauntlet as
Absolutely.
well. And this the escalation is becoming a real issue.
And you talk about the safety of the crew, which is obviously crucial. I mean, we've looked closely over the years at maritime piracy and the statistics associated with maritime piracy. And I suppose in the last 10 years, there have been dips and increases, depending on where you are, whether it's the Gulf of Aden or Southeast Asia, Indonesia, Malaysia. Is piracy causing any issues on the claim side in the context of these disputes? Or how would you place piracy in the geopolitical tensions of the past 12 months or so?
I mean, obviously we had a big spate of Somalian piracy in Gulf of Aden a little while ago, which seems to have abated somewhat. But what we are additionally seeing is vessel seizures by Iranian authorities, which is causing an increase in vessel detentions, and crews, cargoes, and vessels are being detained. And sometimes they're released within a reasonable period of time, and sometimes they're not. And then, so what we are seeing is now an increase in blocking and trapping claims. So basically, where a vessel owner is deprived or irretrievably deprived of their vessel for 12 months or whatever the specific time period in the clause allows, it's been agreed in the contract, that enables them to claim a constructive total loss of the vessel. So we are seeing an increase in that. Obviously, you have the added complication of a lot of these places are being sanctioned countries, and if there is involvement with locals for facilitation payments and those sorts of things that owners have to make, to save the lives of their crew, which they're going to do, and is only right. That then causes complications for insurers who are subject to all sorts of sanctions regimes, depending on where they're based, which I'm sure we'll talk about a little bit later on as well.
And how about ransom payments? Is that something that you've been looking at? So obviously ransoms will be claimed in order to release the crew. The difficulty in the legislation under English law is that there's Section 20 of the Terrorism Act, for example, where you're not allowed to pay ransoms. So I don't know whether this is something that either of you have come across in the past 10 years, perhaps?
I think it sort of touches on the piracy business model, depending which part of the world you're talking. So in the archetypical sense of the word, piracy is pure theft of goods on board a vessel. I think what the Somalis done in terms of changing their revenue model was to basically hijack vessels, hold them ransom, and that leads to discussions and negotiations in terms of paying release money for crew and cargo. So yes, there have been a number of settlements made under very difficult circumstances and with a lot of legal and compliance restraints, obviously. As time will tell. I think one of the interesting side effects of the Red Sea crisis, if we can call it that, is that there's a mild expectation that it's not to be ruled out that piracy could flare up again in that part of the world, simply because it's a very poor area. These people are destitute. There's all sorts of human reasons why you could say there's a rationale. There's a certain rationale to it. But at the same time, there's still be fewer vessels. Some of the military convoys that were in place for a considerable period of time are no longer there, or perhaps have caught their eyes off the ball. It could easily happen again. It's abated somewhat, but it could easily come back.
And piracy, of course, is a way of funding and financing terrorist groups. So if the terrorist groups, for example, feel that they're short of cash, short of money, then piracy might rise again, I suppose.
Yeah. Yes.
Rob, you mentioned sanctions and thought we'd talk a little bit about the Russia-Ukraine war. So end of February 2022 is when the aggression and the violence started and the invasion. Figures demonstrate that about 8 million Ukrainians out of a 41 million population have been internally displaced. And I think in April 2023, the figure was that there were 8.2 million Ukrainians that had fled the country. So we're looking at the Middle East escalation in violence. We're also faced with the war in Ukraine. I don't know whether either of you can draw any comparisons or similarities with what's happening in the world of claims and marine insurance that's coming from there. I mean, obviously there's sanctions, which we'll talk about slightly later, but do you see any similarities between what's going on in the Red Sea, what's going on in the Black Sea?
If I can take that.
Yeah, absolutely.
So with the Russian invasion of Ukraine in February 22, we saw a large number of vessels in the Black Sea and the Ukrainian ports, which were effectively seized or detained, were stopped from leaving, some of which had cargo on, some of which were unloading, some of which were offloading. And there's a various number of ports along the Ukrainian coast there. And Mariupol obviously was heavily hit. So some vessels were actually destroyed. Some were perfectly intact. They just couldn't leave. And the Russians laid a large number of mines in the Black Sea in the entrance to the relevant ports. And so they couldn't physically leave. And so what we saw there was, and a dramatic increase over a year of those blocking and trapping type of claims where the vessels were irretrievably deprived. And that provides insurers with its own challenge, because we don't really want to be ship owners. We're in the insurance business, not the owning business. And we leave that to the experts. So that has caused some issues there with ongoing crewing requirements, maintenance of the vessels, because as and when they are released, they need to be able to leave and still be in good condition. And that's a daily requirement. So those challenges have been interesting for insurers and new. The Red Sea is different. We haven't, other than the Iranian situation, which I mentioned, Jonathan, we haven't seen. It's mainly been physical attacks on the vessel. So it is a different kind of kettle of fish, so to speak, to from the Red Sea to the Black Sea.
Thank you very much. Eric, any of you?
No, I wholly concur. I think from a market perspective, I think what has happened in both scenarios is the war covers were obviously suspended, subject to notice of cancellation provisions, and with the market then sort of stepping up to the border plate by offering reinstatement solutions, i.e., will provide the war cover again, subject to additional premium. So in practice, what we've seen is certain areas were wholly excluded. There's certain geographic territories or certain geographic areas which are being denominated as being unsafe and therefore warranting extra premium. And I think that's valid for both regions. But I think in the Black Sea, the loss history, if I can call it, has been slightly different compared to the Red Sea. I think you've probably seen more outright attacks in the Red Sea, hitting the headlines as well. Whereas in the case of Ukraine, it probably started off, again, on a very general level as a blocking and trapping situation. And then there was the grain corridor, which was ultimately quite successful. There weren't too many vessels ultimately attacked physically. What we're seeing the last 2 weeks, bizarrely enough, is almost like small actions, but quite painful. There was one vessel, I think she was called the Aya, who came out of one of the deep sea ports. She was attacked just outside Romanian territorial waters. It was almost as if a statement was to be made. And the last few days, we're beginning to see vessels being attacked whilst they're loading. So again, the market's sort of trying to keep pace in terms of providing war coverage. Initially, it was more outside territorial waters. Nowadays, we can look at options to cover vessels whilst they're being loaded. So the market is trying to keep pace with events as they unfold. But it's true that it's still a very challenging situation by and large for both areas.
And stepping aside from war for a moment, just interested to hear from both of you about patterns of claims. So there's been a lot of reports about explosions of lithium batteries and fires on ships, misdeclaration of cargo, misdescription, outturn losses. Just perhaps if I can start with you, Rob.
Sure.
Are you seeing a claim trend that's emerging at the moment?
I mean, lithium-ion batteries is an extremely interesting subject. We could probably spend a whole podcast just on that subject. It's interesting because I was listening to some underwriters talking about it a little while ago, and they were saying, well, of course, lithium-ion batteries are in everything. It's not they're in new motor vehicles now, used motor vehicles that are coming onto the market. They're in electric scooters. They're in your toothbrush. All of that stuff goes on board vessels, and all has the propensity for thermal runaway, which causes those fires, and they are extremely difficult, if not impossible, to put out with a reasonable level of safety and time. And so there have been some headline losses of vessels, such as the Fremantle Highway, for example. And I do believe, it might be a bit controversial, but there's some controlling of the narrative involved by motor manufacturers and maybe even governmental authorities here, because all of the headlines have always been it's a used motor vehicle that's caused it, or it's been a damaged battery. And of course, the risks of an aging battery or a damaged battery are fun, I'm sure exponentially higher than in a new motor vehicle. But if you listen to some of the first responder narrative, and there's a recording actually of the Fremantle Highway, a first responder says it started in a car. So it doesn't get any clearer than that to me. But maybe that's a controversial view. But the risks are there to be covered, and I know there are people who are specialising in specifically responding to that need.
Yeah, and I think it's certainly been a case of the market beginning to shy away from that risk. There's only so many people who still seriously look at automotive risks in general, but certainly EV vehicles are perceived to be a bad risk. Rightly or wrongly, there's arguments for and against. There's a huge debate out there. But on the ground, in terms of finding solutions, it's not an easy broke to do these days.
And cars and cargo is a niche area of the reinsurance market, and some people have large appetite for it, and of course some people don't. But lithium-ion batteries as an emerging risk, I think it's probably emerged now, to be honest. But as an emerging risk is something that some people are very interested in specifically underwriting.
Sure.
As is the way of the marine insurance market. It's always evolving and seeking out new opportunities to provide products to support.
And I suppose that leads us into a wider topic about autonomous vehicles, driverless cars, crewless ships. Marine insurance is very much looking at innovation and technology the whole time. And if you are looking to underwrite risks in these areas, you need to be cognizant that the claims will come and there'll be new claims, and you need to equip yourself with dealing with those claims. Eric, commodities are transported largely by ship. Are there any trends that you're seeing in commodities claims, or what are the commodities companies seeking when they are transacting insurance?
Well, there's so many things you could say. I think the first two things that spring to my mind is one is value, insured values. It's a cyclical business, no surprises there, but a lot of the raw materials being traded have had unexpected or slightly odd price hikes. If you look at what coal's doing, it warrants serious exposure, serious premium volumes, and therefore potentially also claims. Crude, on the other hand, is possibly a bit under pressure. So that's the first thing I'd say. In terms of dovetailing that to trends, data is becoming more and more important. So for underwriters, it's all about aggregation. Storage risks are being monitored a lot better than they used to. It's also being asked for. So for clients, and that goes for commodity clients or other clients, the information requirements are probably more onerous, if not extensive, compared to a while ago. So those would be two things I'd touch upon, but obviously you can talk about commodity marine trends for a lot longer than we've got time for today.
I think, misappropriation has always been an issue. I'm not here to plug it, but I did write a paper about misappropriation losses in the cargo stock market. And of course, those commodity traders have to access and store and ship and sell goods in multiple locations around the globe, and they have to entrust their goods quite often to a third party, a collateral manager or warehouse keeper, in order to access those markets.
Absolutely, yeah.
And there is, with increasing commodity prices, as you point out, Eric, you've got an increased level of moral hazard there, and pressure on keeping that sales process going in order to facilitate those trades.
And over the past 18 months, 2 years, we've seen fraud actions, haven't we, on the paperwork for where commodities are stored, actions against collateral managers as the commodity product becomes more expensive than those who are looking after the inventories and guarding the actual physical warehouses. There are actions against them when product goes missing in different places around the world. And we also see surveyors and adjusters moving away from that market for fear of being sued. So the commodity is just left there unprotected. So, those spiraling claims will also have an impact on premium. But interested to hear what you've said about commodities, Eric. Do you think that you said that there was more of a burden on the insured now to provide information to underwriters before a risk is bound? What is that burden doing to the marine insurance market? Are companies still keen to buy insurance? Do you think companies are moving away from purchasing insurance? How is the market? How are commodities companies impacted by the pricing structures, the rise in premiums, and what are their behaviours now as a result?
I think it. All depends. As the typical answer any broker would give you. It all depends. But I think the first thing I'd say is it depends on the size of the company. You'll have financially very stable group, and some of these commodity players are very big groups indeed, and they've got deep pockets and they're very financially solid. So some companies may opt, for instance, for increased retention levels or high deductibles, if not outright captivation solutions. Captivation solutions being you build your own insurance company, you try and keep as much of the risk in your own books rather than cede it to the commercial market. So there's an element of that we're beginning to witness. The commodity world was perhaps slower to wake up to captive realities or captive possibilities compared to more traditional manufacturing style businesses. In terms of providing the data, I like to think that it was certainly a cultural shift a few years ago, but by and large, people have come around to the idea of, yes, we do need to provide details on counterparty checks. We do need to provide vessel details up front. We do need to provide a lot more detail about what is going to be shipped where from, where it's going to be stored, what are the documents being provided, do we hold title? If so, what documents do we have to substantiate? So I think clients have adopted that mindset and there's procedures in place. And so it creates an awful lot of extra work compared to a few years ago, I would say. But I think the industry is, as it always has done, we just tend to adjust and adapt, and it's become the new normal, however laborious it's turned out to be.
I think if you're a global commodity trader, if you're a risk manager of a large organization, when it comes to your insurance, I'm sure there's always a tension between what do I need to pay, what is the price, and what terms can I get for my insurance. And you're probably better placed to comment than me, Eric. But as opposed to having a captive insurer or some other self-insured retention or alternative risk transfer mechanism. So I'm sure it of course it's down to price, business efficacy, terms and conditions, all of those things. And we have just recently seen a very large global commodity trader has chosen to self-insure through their own captive for their global cargo program, which is a huge decision, and if will can affect the cargo market, because they've been insured for 20 plus years in the London insurance market, and so those decisions can happen, and they do have an impact.
There's trends and fashions in insurance as well, believe it or not, however exotic it may sound. I mean, this period, it sort of ties into the state of the market. Sometimes the cost of insurance is viewed as being acceptable or cheap or expensive, whatever the market does, and that will in turn drive certain decisions like you've described. So it all comes together. It's all interdependent.
I like the way you managed to get the word exotic and marine insurance in there. I'm not sure I've heard that one before. But anyway, I might use it.
Very exotic. The value of the world fleet is approaching $1.6 trillion in 2024, which is an increase of 13% from 2023. So there's obviously going to be a demand for insurance and insurance products. Have you seen many carriers exit the market, new carriers come into the market? Eric, maybe a question for you.
Well, I'm obviously a cargo expert more than a hull expert. What I do know is this: the world's fleet is aging. That's for sure. There's scrapping. The volume of tonnage being scrapped is less than what it's historically been. So it's recycled now. Yes, turns into electric batteries, I suppose. So this and the pace of new builds is slackening as well. So you end up having a world fleet, which I think is on average 2 or 3 years older than we used to be recently. So there's certainly that. Vessels are getting bigger as well, by and large. Depends on the type of vessel you're talking. So the hull values would be increasing. So all of that then translates into an insurance proposition at some point down the line, and therefore premium cost. So that's certainly one consideration. What the industry will probably keep on doing is look at fleet composition and ownership structures and flags of convenience or other. So you'll have different makeups in terms of, or different shifts in fleet makeup, I would say. These are things that the industry will need to deal with very much as before.
So I think the ability of the insurance market to adapt to new risks that are emerging is absolutely there. You know, we've seen 300 years worth of innovation in the marine insurance market so far. I'm sure we'll be another 300 years. We'll still be here. Maybe not.
Well, the three of us might not.
No,
not after today, I think.
The Lloyd's market and other insurance markets, of course. Thank you. So Eric, you talked about the aging fleet, and perhaps we'll talk about the dark fleet and the ghost fleet, as they're called, a little bit later. But when it comes to the environment and ESG, obviously there's been a drive to cut emissions and for vessels to understand the importance of environmental concerns. To what extent have you seen the environment, weather incidents, and a focus on ESG change the way that you work and what you do?
Okay. Well, I think it's beginning to make its impact. It's beginning to make itself felt. We've recently been pitching for, again, commodity business, as you know we do. One was petroleum related and the other one was old-fashioned coal. And you do notice that some markets are beginning to wonder whether this is a business they want to be engaged in long-term going forward. So I wouldn't say that this is absolutely no-go. There's lots of expertise, lots of know-how, but there's certain pockets of capacity that are beginning to be withdrawn, perhaps more from an ESG perspective, if not moral reason, than for a technical reason. So that's certainly something that we're beginning to witness. And I suppose it's early days, but that is not to be discounted going forward as a concern, because obviously at some point those people, those assureds will need to have protection in place no matter what. So that's certainly another challenge for the industry to address. But then again, talking about trends in fashion, in insurance, it ebbs and flows, and that's certainly something that we're beginning to notice.
There have been attempts to reduce premium for those companies that are striving to meet their emissions targets. That's been one way that the insurance market is rewarding those that are complying with the various rules and regulations. Rob, have you seen that weather patterns or perhaps a focus on the environment has altered what you do?
I mean, we've seen a big increase in losses associated with convective storms over the last few years. There's been a large increase. I mean, we've just literally come out of 2 hurricanes, Lane and Milton, which have affected the insurance market across Florida and Georgia and North Carolina and various other places. I mean, and we've seen a general increase in that globally, flooding claims, that's sort of for cargo warehouses, windstorm damage, all of those things. So yes, there's definitely an increase in those. I mean, just going back to the point about electric propulsion and zero emissions. It would be interesting, in the circumstances of the MV Dali, which stuck on Baltimore Bridge, for example. I think the original NTSB investigative report said that it was caused by an electrical failure, which may have been a crew negligence issue, or may not have been, may have been a maintenance issue. We haven't got to the bottom of that yet. But what would have happened in that instance if it was an autonomous vessel with no crew on board, or if it was an electric propulsion vessel? Would the steering gear still have failed if there was an electrical failure in the bus board that was allegedly caused the steering gear failure for the Dali? Don't know the answer. So I think there are lots of considerations there. It was interesting just on the Baltimore Bridge incident. I was again listening to an underwriter and a claims person discussing it shortly after the incident in March this year. I think it was beginning of April, just after the owners, Grace, had filed for limitation under the Merchant Shipping Act in the States of 1851, which sought to limit their liability to the sound sale value of the vessel, which is about 90 million plus less the cost of alleged repairs, which is going to be about 50 million. So then the number looks about 42 million. And that law has been in place for a very long time and has, not sure it's ever actually been broken. It was there to support the US merchant shipping fleet in the mid-19th century. And it became rather famously known as the Titanic Law, because the White Star Line sought to limit their liability under that Merchant Shipping Act of 1851 as a result of the sinking of that very famous vessel, and it was upheld. So, what was interesting in the conversation was on the liability underwriting perspective, it's okay, it's a $42 million loss, but actually, the federal government has started a civil action directly against the owners in the States to try and reclaim the $100 million of the federal government's money, which they spent in cleaning up the incident. And of course, the Baltimore State themselves have filed an opposition against the limitation, seeking privity of the owner to try and break that limitation. In which case, depending on who you talk to, the loss is going to be $2, $3, or $4 billion. So that's far from over yet. So I think that's going to be very interesting to see how that pans out. And if limitation is broken, that's going to have a pretty huge knock-on effect on the P&I market and the liability market for owners.
And well, I'm interested to hear what you're saying, because you talk about 1851 and you keep on going back to 1851 as the law that's in place. And then we talk about innovation. And 1851 was a very long time ago. And for us in insurance to talk about innovation, but still refer to that year seems quite odd. It was also the year of the Great Exhibition in the UK, where innovation and technologies were displayed. And we find that we hark back to 1851 as well, but maybe we should be going slightly faster and move forward to see how the world is evolving and changing. You talk about limitation in the context of the Dali, but I just want to talk more broadly about limitations in general, and then to move on to sanctions, because since the beginning of the war, so February 2022, Russia's invasion of Ukraine, there's been a whole series of sanctions that have been imposed. So in the UK, we've had the Russia-EU Exit Regulations 2019 and SAMLA 2018, which set the framework for sanctions rules. And what we've seen particularly are, I suppose, sectoral sanctions. So sanctions relating to nuclear energy. We've seen the oil price cap, dual use technology. So there are restrictions on goods that are moving around the world. And then we get the designated individuals and the designated entities, those that appear on a list. So you can't transact with them or trade with them. Just interested to hear from both of your angles how sanctions are influencing your work. Don't know whether I should start with Rob or Eric.
I'm happy to kick off.
Thank you.
It's made it a lot more complicated. Yeah. Is the simple answer, and the slightly longer answer is that as a claims person in an insurance company, you are very cognizant that you are subject to an ever-changing world, and sanctions imposed, and especially designated national SDNs. You've got OFAC, you've got European law, you've got UK. It's an extremely wide and set of sanctions that changes every day, and basically makes our job more complicated. Takes longer. Each and every claim takes longer. And, if they have designated touch points in certain areas, then that there's nothing you can do about it. And, what we do see is that we have every insurance company is different, has their own internal sanctions checking procedures, has their own internal legal and compliance teams. And, every time we get a claim which might have a touch point or might be involved in something like the Russia-Ukraine thing, we have to go through that sanctions checking process. And we're cognizant that we absolutely have to comply 100% with all of those sanctions regimes. And, if that means, we can't pay the claim because of that, because it would break the law to do so, we absolutely can't. And, we have to discuss that with the underwriters and with the brokers and with the assureds, and be very clear and transparent about what that means.
I can see it becomes a much more convoluted process and perhaps doesn't help the end insured, but obviously you've got your contractual obligations that come from the contract of insurance, but you've also got to comply with sanctions legislation. There are sanctions exclusion clauses, which are suspensory or final in the way that they're interpreted, but they add another layer of complexity. Eric, have you experienced sanctions issues?
Same thing, I would say. I think what you're also finding is that the nature of the beast, I suppose. Business tends to adopt, and we're always playing catch up being in the insurance industry, and it's a very fine line to try and stay abreast and certainly not trespass or make any mistakes in that respect. But at the same time, for instance, one of the trends we're witnessing is some of the Russian entities or Russian individuals or Russian trading companies or whatever they are tend to uproot sticks and move to places like Turkey in the Middle East. So for us, that presents with a challenge in terms of keeping up. It's more than just vetting a ship or a particular trade deal. It's also the individuals and the corporate structures behind them. And sometimes they're absolutely okay, but you just still need to go through the checks. It's a very cumbersome and risky process, and it's not a game where prisoners are taken. You've got to be very, very careful. And like you were saying, Rob, I think it starts off chronologically. It starts off from the moment that you are presented with a new piece of business or even an existing piece of business that you need to validate, and that permeates all the way through to a potential claim that needs handling. So, and it's not because the business was rich in the first place that will automatically entail a loss being legitimately settled. Again, in that sense, it's linked, but not necessarily an automatic result.
And at this moment, it's probably worth mentioning that the dark fleet or the ghost fleet figures change, but that's possibly 1,100 ships that are sailing old, uninsured, under the radar. Vessels now themselves have been sanctioned, which is a new wave of sanctions. And of course, if an insurer is associated with the dark fleet, then the penalties and fines are enormous. Custodial sentences.
Yeah.
We've had £1 million mooted as a potential fine, could be 6-7 times more than that. So brokers, insurers, solicitors need to tread very carefully about working out who their counterparty is and carrying out the necessary due diligence. Thank you. So if you could polish your crystal balls and look into the future, we'll do a bit of future gazing, perhaps just to end. Now, I have looked at various elements and what might be lying ahead for us. There are tensions between China and Taiwan, and we've seen that there are potential acts of aggression, and that might lead to sanctions in that region as well. The sanctions on Russia have led to different trading relationships. Mm-hmm. So China has come to the fore, India has come to the fore, and we've seen that evolve. Potential sanctions also for Belarus. And we've seen tension and friction between North Korea and South Korea, and missiles flying in different directions. So I think that those perhaps are some of the risks that we see with geopolitical tensions on the horizon. Are there any other risks? What do you see for the future in terms of geopolitical tensions and marine insurance?
Well, I think, if you just look at it from a purely economic point of view or even business perspective, it starts with, there's all this talk about nearshoring and onshoring and friendshoring, and is deglobalization an actual fact? Is it happening, or what's going to happen to physical trade flows to begin with. You've got a lot of countries putting up trade barriers and what have you, so that's certainly going to have an impact. At the same time, a lot of the big economies are still growing at a healthy rate, so God knows where the balance is going to tilt. And then throw in all the other bits. There's the challenges posed by digitalization and AI, and you mentioned geopolitical and regulatory risks. They're certainly not going to become any less. So we'll be kept busy, I think, going forward.
Oh, I agree.
And especially you with claims, Rob. I mean,
thanks.
I'm sure of that.
Yeah, I mean, I agree with everything that you just said there, Eric. I mean, it does feel like the world has gone geopolitically crazy, and we've had Israel, Gaza, Russia, Ukraine. We've had North Korea now. We've had civil uprisings in Haiti, Myanmar. We're just seeing more and more and more of it. Obviously, we've got U.S. elections, and ex-President Trump's attempted assassination. I mean, it just seems like there is an awful lot of that going on in the world right now, and whether I mean, obviously that requires a reaction by the insurance market in order to provide relevant products and services to people who are caught up in that as part of their daily business. So it's up to us to innovate and make sure we're there to support on the ongoing global trade. I mean, I don't know what the future holds in terms of emerging economies. I mean, obviously now we have India is the most populous country in the world now, I believe. So, I'm sure that's going to, there's going to be a trend associated with as they become more and more developed and they produce more and more commodities and goods for the world. Maybe there'll be a shift in the balance of power, maybe from the Far East to there. I don't know. It's difficult to say, but we do as in marine insurance market, of course, we do need to provide solutions for the future of shipping, and that might be vessels with no one on board, electric propulsion, all of those kind of problems that require solutions for the future. But yeah, I'm sure that we'll be here for a very long time in order to do that.
It's easy to forget, isn't it, the importance of marine insurance, because marine insurance protects global and international trade. So it's there to pay the losses and it's there to facilitate the trade, because without insurance, these large companies would not be able to transact business and continue because it's the safety net. So in that respect, I think marine insurance is a constant and a constant support for world trade, which makes sure that people have their luxuries, they have their food, and they can operate in a normal way. We saw disruptions through COVID-19, and the list that you actually just, I suppose, provided to us of all these geopolitical disasters is in contrast to just how we still seem to operate thanks to marine insurance. But as we close, I just wondered whether I can pass perhaps first to Eric and then to Rob, just to understand what you think the future of marine insurance will look like. Are we going to see any big changes in the way that perhaps brokers operate, carriers operate, reinsurance, alternative risk? Is the market going to contract? Is it going to get bigger? Just be very interested in your closing thoughts, Eric.
I'd be struggling to drum up one conclusion. It could be any of that or all of that in varying degrees. I think what is for sure is that the market will continue to adapt as we've always done. In which ways it's hard to foretell, but I'm sure we'll do what is required and do what is necessary. So yeah, it's business as usual almost.
I think for me, if I look back to when I started in the market 30-something years ago, the Lloyd's market, for example, the Lloyd's market was a $9 or $10 billion premium income. Now it's 2023 is $51 billion. I mean, that's a huge increase. I don't see that abating, I think. And a lot of that increase was predicated on what happened in the global economic crisis. 2008, 2009 was a real kickstart for Lloyd's market, which was seen as the solid benchmark for insurers. And I think the same is true of marine insurance, albeit marine insurance obviously started the market 300 years ago, is now only 9 or 10 or 11% of it. So, it's a smaller part, but it's nevertheless a very key part of it. And you'll find that a lot of insurance companies who want to start a Lloyd's syndicate, for example, will be interested in marine insurance because it's the traditional class. It's the one that's solid. And whilst you have a number of liability classes where your results might be like that, marine insurance does seem to be more like that. So it provides solidity and capital spread of risk, I think. So I see a bright future for the London insurance market and global marine insurance market, actually. And I think we can continue to adapt and change, as we have done for a very long time, to these new and emerging risks.
Terrific. Well, thank you very much indeed, both of you, for your insights and your comprehensive answers, and for joining me here today. Thank you.
Pleasure.
Thank you very much.
Thank you for listening to Risk Matters, the DWF Insurance Podcast. We hope you join us again soon for future podcasts in our series.